So growth is strong. There's no question about that. Inflation's on the rise, there are capacity pressures. There's some questions about whether or not wages should be growing more rapidly than they are, but wages are growing at a reasonably rapid pace. This is all indicative of inflationary pressures now and inflationary pressures in the future. To keep those under control, which is the bank's mandate, it's got to raise interest rates. We think they're going to go to 3% by early 2020, so double where they are now. It seems like a huge number. When you say we're going to double rates, it sounds like an impressive increase. But the reality is it's about 25 basis points a quarter for the next 5 or 6 quarters. That is a very gradual pace of increase. And we've seen no evidence really so far that the 100 basis point increase that's been put in place has had tremendously damaging impacts. Consumer credit growth has slowed, that's normal. Mortgage growth has slowed, that's normal. Default rates continue to fall, which isn't suggestive of stress. Whether it's in Canada, whether it's in the US, whether it's in Europe, interest rates have been at extremely low levels for an extremely long period of time. So there's an issue of how will the economy adapt to that? How will people respond to an environment rising interest rates, whereas they've not really experienced that of any significant degree for the last 10 years prior to this tightening cycle. Again, the evidence that we see so far suggests that they've been able to manage that reasonably well. But part of the reason we've been able to manage that reasonably well is that longer-term interest rates, so rates at the 2-year level, the 5-year level, the 10-year level, have risen much, much less than short-term interest rates. And much consumer credit and almost all mortgages in Canada are based off these longer-term interest rates.